Let's move on to the second part of our mini-series about how money is created, which will cover private banks and debt-based money. The private banking sector is responsible for the great majority of money created today. Banks create around 97% of the total money supply in most modern economies using digital means. As a result, the majority of the world's money is private.
Welcome to Cryptic, a channel that gives critical evaluation or analysis, especially in dealing with crypto. Everything regarding money, finance, investing, cryptocurrency, and blockchain-related topics, including ICOs, NFTs, and yield farming.
In the past, after several early bank runs, banks were able to persuade politicians to create digital money. A bank run occurs when depositors attempt to withdraw all their funds in an instant, but the banks are unable to do so. As a result of these developments, banks claimed that they should be permitted by law to generate more deposits than there really are, based on debt. This is how governments delegate the production of digital currency to the public. The concept of using debt as a form of payment dates back way further.
In 1704, English entrepreneurs paved the way for banks to emerge as the world's money generators. The Promissory Notes Act was approved by the English Parliament. Take a close look at what you're seeing now. You're looking at a promissory note. It's a written commitment that you'll repay the $30 you borrowed in this situation. This document was worth $30 according to the law. This arrangement is now computerized and referred to as debt. To assist you in familiarizing better, every time I say debt in this video, I'm referring to the document of debt, which it is equivalent to money.
Not until your debt is paid.
So, banks will grant permission for these debt documents to operate as money. Banks were empowered to generate and erase debt after this time. As a result, in the world today, money from individuals is rented out for a profit. As you'll see, these commitments sustain the entire global economy. Let's have a glimpse at how it functions right now. Whenever you visit a bank to borrow money, the bank's banking license allows them to generate money each time they make a loan. This is accomplished through the use of a double accounting system. Let's say, for example, you purchase a $600,000 house. The bank will then deposit $600,000 into their account. You now owe $600,000, and that is the pledge to repay the loan plus interest. This $600,000 debt has the potential to spread across the economy. Since when you buy a house, the seller of that house can utilize the new debt generated by the bank using the money you gave them to purchase other products in the economy. This means that in our present system, if you want greater growth, we'll have to take on more debt. The important aspect to remember is that debt is money, only in a different way. It's a monetary asset to the lender. Meanwhile, it's a debt responsibility on the borrower's end. They are, nevertheless, one and the same. It may sound confusing, but all you have to learn is that anytime a bank prints its own bills, it is not using someone else's money. The bank's previous money is not used. They're effectively creating a brand new money. They basically type it into a computer where it shows a digital representation of government funds that you can spend. The benefactor of this brand new cash is, in fact, the bank, since they get to collect interest. That's how they earn money when you pay back the loan. The debt is gone and the money's gone as well, but the bank's interest profit remains. The largest instruments towards producing digital money are the real estate and property markets. It's because banks have determined that it is the simplest and most profitable method of debt creation. Because if you don't pay back the loan, the banks have the right to seize your home. The mortgage market in industrialized countries supports large sums of money. It's been particularly unpleasant here, where I live in Switzerland, for decades. Banks have now ditched investments in the general economy and redirected their focus to home assets. As a result, house prices have risen. People are taking on additional debt to buy homes they normally couldn't afford, but banks are profiting. This cycle has resulted in one of the largest property markets in the history of our Earth. We have a debt addiction. Yes, as individual people and as communities, we are addicted to debt. So, if you think this video has clarified some things for you, please consider liking it and clicking that bell button to be notified of our new videos. Also, you might want to consider subscribing to our channel. It'll really help us out. Back to our video. Up to this point, we've covered loans. So, what about deposits? We are required to make a bank deposit for our loans and other bank services. That money is not your legal property anymore. It's the bank's now. They hold 10% of your deposits in reserve and can transfer 90% of those funds to another party. That person, in turn, could deposit the money in a different bank. The bank can then lend out 90% of that money again, and so on and so forth. Fractional reserve lending is the term for this. When they say that they'll send it to your account, they're misleading you. No money is transferred, since a deposit is nothing more than the bank's document of its debt to the people. It now owes you money, as well as a documentation of the cash. When everything is said and done, all it owes you is what you perceive you're receiving in terms of money. With a $100 initial deposit and a tempest and reserve requirement, $1,000 in total money circulation may be achieved. That's the process in which they operate until the date of March 26, 2020. According to the Federal Reserve, there is effectively a 0% reserve requirement. All depository institutions' reserve requirements were abolished as a result of this decision. In a nutshell, banks now have the ability to produce unlimited sums of money with no reserves. It doesn't end there either. When banks retain your money, they can gamble with it, just like hedge funds, by investing in financial tools like derivatives and securities. They do this in an effort to maximize profits. The majority of the time, these devices are simply bets on whether an asset's price will increase or decline. However, when followed to its logical conclusion, it can become absurd. There are even financial devices that wager on the weather. These insane financial devices are what crashed down the housing market and, with it, the world economy in 2008. However, today's issue is that banks are gambling with so many derivatives, which are often stacked on top of one another with leverage compounding factors. Nobody knows how much money is at stake in this game of chance. According to some estimates, the derivative market is worth more than $250 billion, or more than 10 times the world economy. Everybody gets into debt. They borrow money from a bank and pay for things they couldn't otherwise afford. Like we've discussed, this results in economic growth. However, people eventually run out of money and are unable to repay their debts. As a result, the bank decided to discontinue lending, which made the market begin to plummet. The economy is experiencing a downturn. This is a natural occurrence that has occurred for centuries. However, all changed in 2008. Society did not want to experience the anguish of a recession. According to some experts, this is the exact time at which the real economy perished. Banks had grown so integrated and crucial to the flow of money in 2008 that they were nearly impossible to separate. The government has had to employ central banks to rescue them when they are on the verge of collapsing. Keep in mind that banks create 97% of all money in the form of debt. If this debt is not paid back, it may result in a systemic failure, with the possibility of the entire global financial system collapsing. The economy has been on life support since 2008, when it was declared dead. A decade of ultra-low interest rates, which effectively eliminated the barrier of borrowing money, has resulted in massive market inefficiencies, exacerbating the situation. There were short-term benefits in exchange for long-term agony. When private banks execute reckless bets and lose money, central banks can come to their rescue with their limitless funds. They simply poured money into the system. They have the capacity to generate money digitally as a central bank by purchasing treasury bills, bonds, and other government-guaranteed securities. It's a method of increasing the money supply. However, the Federal Reserve can only provide loans that must be repaid under the law. In the final installment of our mini-series, we'll discuss central banks. However, as you will see, we must repay these debts. All of this new money is exactly similar to that piece of paper with a promise on it that we discussed earlier. However, we've all signed it. We were required to pay this back through taxes, both now and in the future. It's crucial to remember that governments don't really reinforce the people. The people are the ones who reinforce governments through taxation. The two most common ways for governments to raise funds are through taxation and commerce. This money is raised and used to repay central bank loans with interest. As a result, when governments utilize central banks to rescue private banks for their reckless conduct, the governments are left with a debt that must eventually be repaid by taxpayers. To summarize this video, private banks produce the vast bulk of money, roughly 97%. They accomplish it by producing debt in the form of loans. It's as simple as punching figures into a computer. Since banks legally hold customer deposits, they can spend and gamble with them. When banks fail miserably, the government or central banks back them up, which is then left to us to pay through taxes.
You want us to pay tax to France?
Acquired a lot of knowledge from this? Check out our other relevant videos from our channel. Don't forget to subscribe to this channel and hit the thumbs up button for this video. Also, share this video to any friends or family members who might find it useful. Until next time for the final part of our mini-series.